Hello to all. Today, we're going to talk about money and banking. This is usually, I like to do a whiteboard with this, but without doing it dynamically, it's a little difficult. So I'll try to explain it, and I hope everyone can follow without too much trouble. Money itself is relatively simple. Money is anything that people will can use to trade for something else. What do I mean? Well, at one time we used commodities, hopefully rare ones. Native Americans, American Indians use shells. Well, it didn't work well on the coast because then you could expand your wealth real quickly by going to the beach. But if you're inland and they were rare, what worked? If you were back in the days of Paul Revere and you're looking at your mother's silver vase that she left for you, and you said, oh, this is really a nice vase, but it's got a dent in it. So I'm going to run over and see Paul Revere and have him fix it. And you go over and Paul Revere says, great, here's a receipt. And on the way home, you see a cow that you think you'd really rather have than that vase. And you go to the person that owns the cow and says, hey, I got this receipt from Paul Revere for this vase. This description on there. Would you take that and go get the vase when it's ready and let me have the cow? If the person is willing to accept it, that receipt becomes a form of money. Roman soldiers were paid in salt. What's the reason for salt? Well, salt, real pure salt, was rare. I mean, you'd think it'd be available easily through the ocean, but pure good salt was rare. It's light, doesn't weigh much. It's easily divisible and is accepted in exchange for all kinds of things. In fact, our term for salary is based upon the Latin word for salt. However, over a period of time, there was a desire to have a more standardized format. So what you saw was taking commodities like gold and stamping them into coins. Then people could tell, hey, this isn't just gold. This isn't just a little gold. This actually is worth $20. It wasn't real divisible, $20 coin, you get an exchange, but they had the silver coins and other things that developed. Pieces of 8 were divisible. Actually, the term 2 bits, probably often heard, was common in my generation that grew up. That was because pieces of 8 really were pieces of 8. They were attached together. And if you wanted to pay somebody and it didn't take a whole piece of 8, you just broke off the bits that were necessary. So we've done that to a large degree, and we kind of standardized this whole system after World War II, Bretton Woods Agreement. And everything was based upon the dollar, and the dollar is based upon gold. And we started printing dollars, most certainly. What we called treasury notes, which were basically redeemable in silver, are redeemable in gold. And then rest of world currencies were based upon the dollar and floated or basically at a certain exchange rate to the dollar. Up in the 1970s, Richard Nixon said, hey, there's no way there's enough gold in the world to cover dollars. And he just took the dollar straight off the gold standard. And all of a sudden, currencies around the nation floated against each other. Whatever was the market price. What did a pound cost in dollars? How much were yen in dollars? Or vice versa. And money became what we call fiat money. F-I-A-T. Same as car, but what it means is by law, by order, by fiat. This is money that you will accept for payment of all debts. Now, not all money is, coins, things like it's fiat money. Most certainly, employee had some difficulty with the boss. He quit. The boss decided to pay him and dump pennies on his driveway in Georgia. And the employee didn't have to accept it. He could say, yeah, that's not legal tender. Give me dollar bills, that was legal tender. You might even be able to dump quarters, and that would be legal tender, but not pennies. So money does this function. However, the amount of money that we have floating around, even the amount of money that comes directly, whether it's electronic or otherwise, is considered money because they are dollars that have been issued by the Federal Reserve System. And they, by the way, they're no longer based on gold and silver. So it's called Federal Reserve notes rather than Treasury notes. It's only a small portion of total money. We have several categories of money. Let me pull that up. And are you here? There's M1, that includes all currency and liquid accounts. That would be checking accounts, traveler's checks. That's immediately exchangeable in any kind of format. Note that it doesn't include savings accounts. Banks can hold savings for 30 days. For that reason, savings accounts, small denomination CDs, things like this, fall in a category called M2. M2 includes M1, but it does include all these other things, and it's about 3 times as large as M1. And then we have M3, and that includes large amount denominations and other types. And it's about 1/3 larger than M2, but it does include M2. And then finally, there's L, and some people argue there's an M4, but really, it really is called L, and I don't know why. And that includes everything, including any kind of financial instrument that might be used. Most of that is created by banks, which we'll talk about in a minute. But just so you understand, all these money, 4 sources of money, are used for 3 major reasons. They are a medium of exchange. Yeah. You can use them to exchange things. It gets rid of the need for a double coincidence of need. I mean, if you're bartering, you have to have something somebody else wants, and they have to have what you want at the same time, unless you're willing to do very complex bartering. No, it's a medium of exchange. You can all understand it. It's an accounting of your wealth. You know how wealthy you are, you can tell. And it's a store for your wealth. You can store your wealth easily without having to have maybe land or something of this type. So money does all these functions, and this is, let's say, more complex than people realize, but it most certainly does serve these functions. And because it works in this fashion, even the cryptocurrencies today are considered money, even though they're not officially sanctioned by governments. They're private, they're still forms of money, but may not be quite as reliable as the forms of money that governments actually themselves provide. So what we're talking about here is that money does all these really critical things. Well, when you talk about money, though, you have to talk about where you store money, how you can create new money, and most certainly can happen. And that's banking. Now, the best way to think about a bank is compared to a used car dealer. Now, I know bankers don't like to think this, but what do used car dealers do? They buy cars cheap. They clean them up and package them. They put them out in one spot where you can find them easily. And then they sell them at a premium. And that's how they make the money. They pay for the lot, they pay for the salaries, pay for profits. What do banks do? Banks collect money from all over the different kinds of places. They package it up nicely into loan packages and things like this. And you know where to go to get it. Go to the bank, talk to the loan officer. And they sell it at a premium. They sell it at a higher price in interest rates than what they paid for in interest rates. So that's what banks do. Now, how do banks create money? Well, banks create money by lending. Let's assume we have a 10% reserve rate. In other words, so the reserve rate here in this regard is the amount of money the bank has to keep in-house when they get a deposit. So let's say you get $1,000, and let's say the reserve rate is 10%. The bank can lend out $900, but they have to keep $100 in case somebody comes in and wants some money. And so, of course, they have all kinds of customers. So they have a lot of $100 or $10,000 or whatever it is. But the rest of it they can take and they can lend out. Well, when they take that money and they go and they lend it, those financial instruments become money. So now you not only have the original $1,000, if you're loaning out 900 of it, all of a sudden you have $1,900 worth of money. And technically, that same $1,000 could go back and forth with HP, a couple of banks, or even with the same bank, being redeposited, bank pulling out 10%, loaning out the rest. You can expand that original $1,000 at a reserve rate of 10% up to $10,000. Now that doesn't happen. There's a lot of leakage and things like that. So the banks would probably, at most, be able to expand it between $2,000 to $3,000. But they can do that. And this is important because when the Fed, we'll talk about this more down the road, wishes to do monetary policy, and they basically put money into banks to stimulate the economy, banks have to do something with it. They can't just sit on it because they have to pay interest. They pay interest even if they don't pay, I mean, whatever, even if they're foregoing opportunities, there's an interest cost. And there's an interest cost and no money coming in. Well, that basically means they're not financially stable. So they got to lend it. And as they lend it, they create more money and expand the ability of our Federal Reserve System to expand the money supply and stimulate the economy. These are critical functions. This is how modern economies work. I hope this helps a little bit understanding. We'll certainly take a very, very hard look at the modules and the textbook and come back and review this or my notes as appropriate. Thank you very much. Talk to you soon. Bye.